so far, this is through the close of business yesterday. The performance number is 6.78%. So we have seen some improvement since the end of June. Again, our asset allocation, we're about 58% in stocks, 7%, and that's in our investment policy. We have a target plus or minus 5% at 55%. So we're a little overweight in stocks at the moment. REITs are 7%. Again, our target there, plus or minus 5%, is 5%. So we're overweight in REITs. The bond portfolio portion is at 32% as far as the allocation, with a target of 35%. So we're a little underweight in bonds. And cash, we currently have about 3% in cash at the moment, and again, a target of 5%. And that's slightly underweight. And I can give you an up-to-date balance here. We're at $115,408,658. And year-to-date, we've taken out about $4.9 million.
All right. On behalf of CS McKee, first I want to thank all of you for taking some time to include me in your meeting today. We're proud to work with over half of the county retirement funds in the Commonwealth. We serve clients in 37 states, institutions ranging in size from small pension funds the whole way up to some of the largest state plan and university plan sponsors in the world. We manage two asset classes for the county. I'm going to talk about today fixed income, which we've already addressed a little bit, and then the large cap value equity portfolio. A lot's happened in the market since the end of June, so I'm also going to give you an update as to where the portfolio is as of the most recent close. For the period ended June 30th, the CS McKee accounts total $57,953,155. And as of August 16th's close, the balance was $58,768,104.71. We have a consistent approach to how we manage investments, whether we're talking about bonds or whether we're talking about equities. Our focus is foremost on the security level and fundamental valuation. We won't make a macro call on a portfolio and try to predict what's going to happen in the economy. Rather, we look at the specific securities and let the total shape of the portfolio be derived from that. With respect to bonds, we've been honored 5 out of the last 6 years as a plan sponsor network top gun of the decade in the core fixed income space. This is based on the risk-adjusted returns that we're able to generate for clients, and it's something that we're very proud of. One of the challenges that the county and all pension funds face is this incredibly low interest rate environment. And I know that Mike and Brett have talked about this in the past, but if you went back to the 1980s or the 1990s, it would have been possible for the county pension fund to put almost the entire plan in stable, relatively safe fixed income securities and generate its actuarial rate of return. That is not the case in the market today. The 10-year Treasury is in a range of about 1.3 to 1.6 right now. It is very, very difficult to maintain construction in a pension fund that's going to get you to that target using the same allocation strategy that could have worked in the past. What that means for everybody here as a trustee is that you have a more difficult set of circumstances than your predecessors. You have to accept the burden of greater risk to get to the same place in making sure that this pension fund is solid for generations to come. And so I think that it's been very prudent and well-intentioned. I know Mike and Brett have given a lot of thought to this, and they work with us and other managers in your plan to make sure that we are diversified and that we have a low alpha correlation across asset strategies. We do not want the entire portfolio moving in the same direction. We want to make sure that you have A, the probability of exceeding your actuarial target, but B, doing so in a way that helps to reduce the volatility. The Wall Street Journal had published an article not too long ago where they talked about the probability of actuarial losses in pension funds. And it used to be back in the 1970s that because of the more concerns, the actuarial probability of loss was for 60-some years back in the 1970s, and today it's about once every 4. So there's a lot more volatility that you just have to contend with, and it's a function of interest rates. But what we've done in our strategies is we've tried to reduce as much of that volatility as we can. We want to get you to the same place where you need to be, but with less risk. In the equity strategy, it's been challenging. Over the last 15 years, and since we initially began running this mandate for the county, we have outperformed our benchmark, the Russell 1000 value, by a significant margin. For 15 years, the Russell 1000 values averaged 6.38%. County's investments in large cap value equities have averaged 7.51%. The way that we've built the portfolio has been focused on the earnings yield, and we like companies with strong balance sheets. If a company's carrying too much debt, it typically does not screen well in our process and has a low chance of making it into your portfolio. The challenge over the last several years, and we've underperformed the Russell 1000 value benchmark for the past 5 years, has been that many of the companies that have been performance leaders in the market are companies that are carrying higher levels of debt. They're benefiting from this low interest rate environment. They're companies that are paying high dividend yields but may not have excellent earnings growth. And so that's been a headwind to the strategy. But as those sectors, and I'm talking specifically about utilities, telecom, and staples, have become more overvalued, we believe that the probability of the sectors that we consider more attractive, sectors like technology or industrials or consumer discretionary, have a better probability of outperforming. Since the Brexit occurred, we have seen a modest increase in yields, the 10-year Treasury. So we are starting to see alpha come back into the equity strategy, and we're not surprised that it's correlated with the up move in rates because of how the fund is positioned. I do have an article that I'm going to pass around here. I thought it might interest you. This is from an analyst named Chris Wiles, who's a friend of CS McKee's in the Pittsburgh area. And the second page of this includes a chart that I think would be really appropriate in talking about interest rates the way that we have. It's showing you a 5,000-year history of recorded interest rates. And we are at the lowest level that has been recorded in 5,000 years. There's over $12 trillion of sovereign debt globally that is at negative yields. It's completely staggering, and we're in a very unprecedented situation. We've had conversations at our investment committees where we've talked about the way the markets have changed, and when the financial crisis took place back in 2008 and 2009, we viewed it as not too different from a game of poker where you have Lehman Brothers and Countrywide and Bear Stearns and JP Morgan and Goldman Sachs all sitting around the table. And when Lehman Brothers ran out of chips, the company went bust. Now we're in a situation where the players are different. We have the European Central Bank, we have the Federal Reserve, we have the Bank of England, we have the Bank of Japan sitting around the table. And whenever the stack of chips get low, they can simply print more currency. They can issue more debt. And it truly is an unprecedented situation. I don't think anybody knows what the end game of it will be, but we do know that the impact that it's having right now, particularly on pension investors, on the elderly, on savers, is that these low interest rates are making it a lot tougher to get the return that you want without really having to take some risks that in the past might have been considered uncomfortable.
Have you learned anything about the bond issue that you're contemplating right now? There was a question about reimbursement from the state. Have you gotten that answer yet?
Not completely. That's part of the reason it's not on today.
Okay.
Is that they're still trying to get an answer from the state, an up-to-date answer. They have an opinion from the state, they being Susquehanna Group Advisors, they have an opinion from the state from several years ago that reimbursement would be forthcoming under that sort of arrangement. And they have confirmed that the federal regulations that dictate that reimbursement have not changed since the last time they got an opinion. As well, the counties that have done the same thing, that have funded or financed the unfunded portion of their pension have all received reimbursement the same way they did prior to that, since that opinion as well, with one exception being Berks County, I think, is appealing a denial of their domestic relations agency reimbursement, but it appears that their numbers were off.
It's
So
a reporting issue.
it's the way they reported it. So they're appealing that and expect, I think, to get through DPW with that, or DHS, I guess it is now. So, I mean, all indications point to nothing changing in terms of that, but we'll get something more definitive from something solid.
Are you starting to think about investments of that, with that money?
Yeah, we definitely, I mean, we're attuned to what's going on here, so, you know, we definitely have been giving that some consideration and understand the importance of, if the county decides to go forward with a bond issuance and putting that money into the pension plan, you know, making sure that it's done in the best way possible, and not putting the money at risk. We recognize where the markets are today, you know, pretty much at an all-time high. You know, we have some thoughts on that. I don't know if we want to get into that today or not. Sure. I mean, our initial thoughts would be to, again, be very conservative in the manner in which we get that, you know, those funds back into the market without trying to time the market. And I think that's important because we're not market timers, and that usually does not go well, whether it's an individual or municipality, as far as trying to time it. So our initial thought would be to keep some money in cash, perhaps the next 6 months worth of distributions, just to keep those liquid and available so that we don't have to go to our current money managers and keep liquidating like we've been doing. That way the managers can continue to get the performance that they anticipate. We would probably also bring the bond portion up to its target, to about 35%. And then the balance, you know, we've been kind of talking about maybe the most conservative way to go about putting the balance to work, and using a strategy called dollar cost averaging, which would be to put a piece in every month for the next 12 months into the equities until it's all put back to work and implemented. You know, if we do have a downturn in the market, it won't have as much of an effect. The downside, which I don't think we're, you know, it's not quite as important. Obviously, we want to maximize returns, but if the market would go straight up from when we start that process, we'd probably miss out on some of the upside. But I think that's how we've always managed the portfolio, is the downside protection on the risk. And it's probably a strategy that we would consider anyway.
Is the duration of the fixed income portfolio of such a nature that if the Federal Reserve increases interest rates in the next few months, that the fair value implication on the fixed income portion will not be negatively affected?
CS McKee manages all the fixed income.
Okay.
And we have made some strides to kind of shorten the duration, so there's less effect on an interest rate movement. I'll let Jeff kind of expand on that.
At CS McKee, for the majority of our pension fund clients, we have shortened duration gradually over the last couple of years. I can remember working with your account when the duration was north of 5 years on average for the portfolio. Right now it's about 3.5. The way that we've structured the portfolio is also a little bit of what we call a barbell structure, which means you have an overweight to the shorter end of the curve, and then you have a little bit of an overweight to the longer end of the curve, and it's hollowed out in the middle because that's the area that we believe there's the greatest probability of an interest rate hike impacting negatively bond returns. So we have a high degree of liquidity and flexibility in the bond portfolio, which should help to mitigate any potential downside risk of an up movement in rates. Run scenario testing on a weekly basis across the bond portfolio to ensure that the structure of the county retirement funds bonds, it's ordered in such a way that it maximizes the probability of adding value across the full range of market scenarios. We're not trying to make a duration call or predict what's going to happen with rates, because we feel that that's the most difficult way to generate performance as a bond manager. Our focus is really specifically on security selection, but we do perform regular scenario testing, and that's what led us to shorten the duration to where it's currently at. We have taken a look at possibly going shorter, but what we found was that the break even would require a move of interest rates to go up by about 0.5% in order to break even when you take into consideration the transaction cost and the restructuring of the fund. We didn't really think that it made sense at this time to recommend an additional shift. So we're very comfortable with where you are right now. We feel that enough of the portfolio, approximately 35%, being at a duration of less than 3 years, everything investment grade, all highly liquid, gives us the flexibility to reposition if we do see further reduction. And overall, we're encouraged by the fact that with a return of nearly 7% year to date, this is looking like a good year so far for the county retirement fund. We know that it's well diversified. We know the fundamentals of the portfolio are sound, and we believe that this, coupled with some probable changes in the county pension law, could be helpful in ensuring the viability of these funds for